The shipping container is perhaps the most overlooked revolution of the modern world, a simple steel box that transformed global commerce, connected distant continents, and allowed a t-shirt made in one country to be sold thousands of miles away for less than the cost of a coffee. For decades, that t-shirt was stamped "Made in China." But walk into any store today and you'll notice something changing. The labels are shifting. "Made in Mexico" is appearing more frequently on everything from electronics to automobiles. From medical devices to consumer goods, this isn't a coincidence or a temporary blip in global trade patterns. It represents one of the most significant economic realignments of the 21st century, of fundamental restructuring of how and where the world makes things. To understand why factories are quietly migrating from the Pearl River Delta to the border towns of Nuevo León, why corporate boardrooms in Detroit and Silicon Valley are redrawing their supply chain maps, and why the future of manufacturing might belong not to the world's most populous nation, but to a country that shares a 2,000-mile border with the world's largest consumer market, we need to trace a story that begins with economic reform in communist China, wins through the complexities of global trade wars, and ends in a phenomenon economists call nearshoring, the return of production to our own hemisphere. This story starts not in Mexico, but in the People's Republic of China in the late 20th century, when a pragmatic leader named Deng Xiaoping uttered words that would reshape the global economy. "It doesn't matter whether a cat is black or white, as long as it catches mice." With this simple metaphor, Deng signaled a radical departure from Maoist orthodoxy. Beginning in 1978, China embarked on what it called reform, and opening up a series of economic experiments that would transform an isolated agrarian society into the world's manufacturing powerhouse within a single generation. The psychological shift required was immense. For decades, Chinese citizens had been taught that capitalism was exploitation, that markets were instruments of oppression, that self-interest was morally corrupt. Now, almost overnight, the state encouraged entrepreneurship, welcomed foreign investment, and created special economic zones where capitalist practices could flourish. This cognitive dissonance, this dramatic reversal of ideological values, speaks to a fundamental truth about human adaptability. When survival and prosperity are at stake, we are capable of abandoning even our most cherished beliefs with remarkable speed. The mechanics of China's rise were rooted in classical economic theory. David Ricardo's principle of comparative advantage suggested that nations should specialize in producing what they make most efficiently relative to others. For China, in the 1980s and 1990s, that advantage was labor hundreds of millions of workers willing to work for wages that seemed impossibly low by Western standards. A factory worker in Guangdong province might earn in a month what an American counterpart made in a day. Yet this represented a dramatic improvement over subsistence farming. The human psychology here is crucial. These weren't exploited victims in their own eyes, but pioneers participating in their nation's renaissance, trading backbreaking agricultural labor for factory jobs that, however grueling, offered predictable income, social mobility, and hope for their children's futures. Western executives, meanwhile, exhibited their own psychological patterns. The decision to offshore manufacturing to China wasn't merely rational calculation. It was driven by powerful cognitive biases. Herding behavior meant that once a few major corporations moved production to China, competitors felt compelled to follow or risk being undercut on price. Recency bias led managers to extrapolate recent geopolitical stability into the indefinite future, assuming that the cooperative relationship between Washington and Beijing would continue unchanged. And above all, there was temporal discounting, the very human tendency to prioritize immediate profits over distant, uncertain risks. By 2001, when China joined the World Trade Organization, the transformation was complete. The country wasn't just making cheap toys and textiles anymore. It was producing sophisticated electronics, precision machinery, and components for nearly every product category imaginable. The term "the world's factory" became shorthand for China's dominance in global manufacturing. To understand the scale, consider this. By 2010, China manufactured more than the United States, Germany, and Japan combined. It produced roughly half the world's steel, 2/3 of its televisions, and an overwhelming majority of smartphones, computers, and consumer electronics. This wasn't simply about low wages anymore. China had built something far more valuable. It had created entire ecosystems of production, what economists call industrial clusters, where suppliers, manufacturers, and logistics providers existed in dense networks that made production incredibly efficient. If you needed 1 million smartphone screens manufactured within 2 weeks, only China had the supplier density, the skilled workforce, and the infrastructure to deliver. This network effect created a self-reinforcing cycle. Companies went to China because everyone else was there, which attracted more companies, which deepened the ecosystem, which made it even more attractive. The philosophical implications were profound. For 2 centuries, Western capitalism had presumed that free markets and political freedom were inseparable, that you couldn't have sustained economic growth without democratic institutions. China's rise challenged this assumption. Here was an authoritarian state achieving unprecedented economic growth while maintaining tight political control. It demonstrated what some scholars called the Beijing Consensus, an alternative model of development that prioritized stability and state guidance over individual liberty and market fundamentalism. This wasn't merely an academic debate, it represented competing visions of human organization. Different answers to the fundamental question of how societies should balance collective coordination with individual autonomy. Western democracies had always assumed their system was not just morally superior, but economically superior. China's success introduced uncomfortable doubt. Yet beneath this triumphant narrative of China's ascent, vulnerabilities were accumulating. The very factors that made China attractive centralized control, government subsidies, intellectual property theft, currency manipulation were breeding resentment in Western capitals. American workers who had lost manufacturing jobs to Chinese competition grew increasingly angry. Politicians from both parties began questioning whether economic engagement with an authoritarian rival had been wise. Technology companies grew frustrated with forced technology transfers and industrial espionage. The human psychology of loss aversion came into play. The pain of losing jobs in industries felt more acute than the abstract benefits of cheaper consumer goods. Studies in behavioral economics consistently show that losses weigh approximately twice as heavily in our psychological calculus as equivalent gains. For American manufacturing communities hollowed out by outsourcing, no amount of cheaper televisions could compensate for the loss of dignity, identity, and economic security that came with good factory jobs disappearing. The breaking point came in 2018, when President Donald Trump launched what would become the most significant trade conflict since the Great Depression. The United States imposed tariffs, essentially taxes, on imports in hundreds of billions of dollars worth of Chinese goods, starting at 10% and eventually reaching 25% on many categories. China retaliated with its own tariffs on American agricultural products, particularly targeting soybeans, pork, and other exports from politically important farming states. On the surface, this was about trade deficits and unfair practices. At a deeper psychological level, it reflected zero-sum thinking, the belief that commerce is a battle where one side's gain is necessarily the other's loss. This perspective contradicts centuries of economic theory, showing that trade can be mutually beneficial, yet it appeals to powerful tribal instincts. Humans evolved in small groups, where resources were often genuinely scarce and competition was direct. Our brains still carry these ancient patterns, making us susceptible to economic nationalism even when our rational minds might recognize its flaws. The trade war created immediate practical problems for companies that had spent decades building China-centric supply chains. A tariff of 25% on a product might completely eliminate profit margins that had been carefully calculated to the percentage point. Companies faced an agonizing choice: absorb the cost and sacrifice profitability, pass it to consumers, and risk losing market share, or find alternative suppliers. The last option seemed most attractive, but it presented its own challenges. You couldn't simply flip a switch and move complex manufacturing to a new country. Building factories, training workers, establishing supplier relationships, and ensuring quality control required massive investment and time. The sunk cost fallacy made this even harder. Having already invested billions in Chinese operations, many executives were psychologically reluctant to abandon those investments, even when rational analysis suggested relocation made sense. This is a classic example of how human decision-making deviates from the rational actor model assumed in basic economics. We don't merely calculate expected values, We attach emotional significance to past choices, letting historical commitments bias future decisions. Then came the pandemic. In early 2020, as COVID-19 spread globally, factories across China shut down. Supply chains that had seemed robust suddenly revealed their fragility. American hospitals couldn't get personal protective equipment. Automakers couldn't get the microchips needed for vehicles. Even toilet paper became scarce because the just-in-time logistics that kept store shelves stocked depended on uninterrupted global flows. The psychological impact was jarring. For decades, consumers in developed nations had taken for granted that products would always be available, that global supply chains were essentially automatic. The pandemic shattered this illusion of reliability. Corporate executives who had optimized for efficiency and cost minimization suddenly faced a harsh lesson in the difference between efficiency and resilience. An efficient system operates at minimal cost under normal conditions. A resilient system continues functioning under stress. These are often opposing goals. Resilience requires redundancy backup suppliers, extra inventory, diversified production locations, low things that reduce efficiency and increase costs. The pandemic forced a fundamental recalculation of this trade-off. The psychological literature on decision-making under uncertainty helps explain what happened next. When people experience a near miss with catastrophe, they dramatically update their risk assessments. Someone who nearly dies in a car accident typically becomes much more cautious, driving at least temporarily. Similarly, executives who watched their supply chains collapse became acutely aware of concentration risks, the danger of relying too heavily on a single country or region. This is where loss aversion intensified the effect. The pain of supply chain disruptions, shortages, and lost revenue felt overwhelming, motivating action in a way that abstract warnings from economists and strategists never had. Human beings are fundamentally reactive rather than proactive. We respond more forcefully to experienced crises than to predicted ones. The combination of trade war tariffs and pandemic disruptions created a perfect storm that finally overcame the immense inertia, keeping production in China. Companies began searching for alternatives, a strategy economists termed China Plus One, maintaining Chinese operations while developing manufacturing capacity elsewhere to reduce dependency. Vietnam emerged as one alternative, offering low labor costs and a government eager to attract investment. India positioned itself as another option, with its massive population and improving infrastructure. But another alternative was gaining momentum, one that offered unique advantages: Mexico. For American companies especially, Mexico presented a compelling case. It wasn't just about moving production to another developing country with cheap labor. It was about bringing manufacturing closer to home, a strategy called Nearshoring. The concept is straightforward. Instead of producing goods on the opposite side of the planet, make them in a neighboring country. The practical benefits are substantial. Shipping a container from Shanghai to Los Angeles takes roughly 2 weeks by sea. From Monterey to Texas takes 2 days by truck. This proximity enables flexibility that long supply chains cannot match. If a product design needs adjustment based on customer feedback, engineers can visit a Mexican factory the same day. If demand suddenly spikes, additional shipments arrive in days rather than months. The economic logic of nearshoring represents a return to principles of economic geography that had been somewhat ignored during the era of extreme globalization. The economist Paul Krugman won a Nobel Prize, partly for work explaining why industries cluster geographically even in a globalized world. Distance still matters. Transportation costs, coordination challenges, and the benefits of face-to-face interaction all increase with geographic separation. For decades, the cost savings from Chinese labor were so dramatic that they overwhelmed these distance penalties. But as Chinese wages rose, having increased roughly 15-fold since 2000, and as tariffs added new costs, the calculus shifted. Mexican wages remained significantly lower than American ones. But more importantly, the total landed cost wages, plus transportation, plus tariffs, plus inventory costs, plus all the hidden expenses of managing global supply chains, suddenly favored proximity over pure labor cost minimization. Mexico's advantages extend beyond simple geography. The United States-Mexico-Canada Agreement, which replaced NAFTA in 2020, provides preferential trade access, meaning goods produced in Mexico can enter the United States tariff-free. Unlike products from China facing 25% tariffs, this isn't merely a technical detail. It represents hundreds of dollars per product that either boost corporate profits or make products more affordable for consumers. The psychological appeal to corporate decision-makers is straightforward. Regulatory stability and predictability reduce uncertainty, which humans find deeply uncomfortable. Behavioral economics research shows that people often prefer a certain outcome over a probabilistically better but uncertain one, even when rational calculation suggests taking the risk. The USMCA framework offers precisely this certainty: a trade relationship governed by transparent rules rather than subject to the geopolitical turbulence. Characterizing U.S.-China relations, the human dimension of this shift extends to the workforce itself. Mexico has developed significant manufacturing expertise over the past 3 decades, particularly in industries like automotive production. Cities like Monterrey, Querétaro, and Aguascalientes have become centers of advanced manufacturing, with engineering schools producing thousands of graduates annually. The cultural factors matter too. Mexico's business culture, while distinct from the United States, shares more commonalities than China's does. Language differences exist, but English proficiency is growing among Mexico's professional class, and the geographic proximity makes bilingual communication easier. Time zones align almost perfectly, meaning a manager in Detroit can have a real-time video call with a factory in Guadalajara without anyone working overnight. These seemingly small factors accumulate into significant advantages when managing complex operations. The psychology of Mexican workers and communities responding to this manufacturing influx reveals interesting patterns of adaptation and opportunity. For workers, factory jobs from foreign companies often pay better than local alternatives and offer paths to skill development. This creates what psychologists call approach motivation, the pull towards something positive, rather than merely avoiding something negative. Compare this to the defensive psychology, often characterizing Chinese manufacturing workers who sometimes view themselves as temporary factory workers, saving money to eventually return to rural hometowns. Mexican workers in growing industrial centers increasingly see manufacturing as a career, not a transitional phase, fostering deeper commitment and skill development. This isn't to romanticize factory work, which remains difficult and often tedious, but rather to recognize how the psychological framing affects worker engagement and productivity, from the perspective of Mexican policymakers and business leaders. The nearshoring opportunity represents economic nationalism of a different sort than the defensive protectionism driving American tariffs. This is opportunistic adaptation, recognizing shifts in global patterns and positioning to benefit from them. The Mexican government has invested in infrastructure improvements, particularly transportation networks, connecting manufacturing centers to American markets. States compete to attract foreign investment with tax incentives and regulatory streamlining. This strategic thinking reflects rational decision-making on a national level, though it also carries risks that we'll examine shortly. The broader point is that nearshoring isn't simply American companies unilaterally deciding to move. It's a collaborative process where Mexican stakeholders actively work to make their country attractive. Real-world examples illustrate this transition vividly. Tesla's Gigafactory in Monterrey represents billions in investment to produce electric vehicles for North American markets. Foxconn, the Taiwanese manufacturer famous for assembling iPhones in China, has expanded Mexican operations. Medical device manufacturers, who require strict quality controls and close coordination with American regulatory agencies, have found Mexico's proximity invaluable. Even industries traditionally rooted in China, like furniture and consumer electronics, are establishing Mexican operations. These aren't marginal shifts. Mexican manufacturing exports to the United States exceeded Chinese exports for the first time in decades, in 2023, a symbolic milestone in this transition. The psychological impact of such landmarks matters. They create momentum and shift perceptions of what's possible. When executives see competitors successfully operating in Mexico, the perceived risk diminishes, while the fear of missing out intensifies. This herding behavior, mentioned earlier as a factor in the rush to China, now works in reverse, accelerating the move to Mexico. Yet nearshoring presents challenges that temper unqualified optimism. Mexico's infrastructure, while improving, still lags advanced economies in key areas. Electrical grid reliability can be inconsistent in some regions. Water scarcity poses concerns as manufacturing expands in arid northern states. Transportation bottlenecks exist at border crossings where thousands of trucks wait to enter the United States, each hour of delay adding cost and uncertainty. These aren't insurmountable obstacles, but they require investment and coordination that tests Mexico's institutional capacity. The political dimension adds another layer of complexity. Mexico's relationship with the United States, while generally cooperative on trade, carries historical tensions. The memory of American territorial expansion in the 19th century, ongoing immigration disputes, and the asymmetrical power dynamic between a superpower and its smaller neighbor all create potential friction points. If American politics shift toward more aggressive trade policies generally, Mexico wouldn't be immune. Despite USMCA protections, political agreements can be renegotiated or reinterpreted under pressure. Security concerns represent perhaps the most serious challenge. Mexico continues struggling with drug cartel violence that affects certain regions and industries, while manufacturing zones are generally safer than areas dominated by narcotics trafficking. The perception of risk affects corporate decision-making. Human psychology is notorious for overweighting vivid dramatic risks, like violence, while underweighting abstract statistical risks. This cognitive bias can lead to both excessive caution, executives avoiding Mexico despite low actual risk in industrial areas, in inadequate preparation for other threats. The broader point is that nearshoring doesn't eliminate risk, it trades one risk profile for another. China offered political stability through authoritarian control, but geopolitical risk from strategic rivalry. Mexico offers alignment with American interests, but governance challenges from corruption and criminal organizations. Neither is objectively safer. They present different risk types, requiring different management strategies. The economic implications of this shift extend far beyond corporate balance sheets. For American workers, nearshoring presents a more complex picture than pure offshoring to China did. When production moves to China, American manufacturing jobs typically disappear with little domestic benefit beyond cheaper consumer goods. When production moves to Mexico but remains integrated with American operations with design, engineering, marketing, and corporate functions staying in the United States, the employment impact is more nuanced. Some manufacturing jobs still leave, but others emerge in coordination, logistics, and supply chain management. The psychological response from workers reflects this complexity. There's less of the pure loss and resentment that characterized the China shift, and more of a mixed reaction that depends heavily on individual circumstances. A factory worker whose job moves to Mexico experiences clear loss. A logistics coordinator whose role expands, managing nearshore operations, experiences gain. The aggregate effect depends on how these individual outcomes distribute across communities and how effectively policy responds to support those displaced. For Mexico, the potential benefits are transformative. Economists project that successful nearshoring could add $1 trillion to Mexican GDP over the coming decade, lifting millions into the middle class and funding improvements in education, healthcare, and infrastructure. This would represent the most significant economic development in Mexico since NAFTA's implementation 30 years ago. Yet history counsels caution about such projections. Economic development isn't automatic or inevitable. It requires sustained institutional improvement, investment in human capital, and navigation of political challenges. Mexico has experienced false dawns before periods when oil wealth or trade agreements seemed poised to deliver breakthrough growth that ultimately disappointed. The psychological concept of temporal discounting applies here. Mexicans excited about nearshoring opportunities must resist overestimating short-term gains while underinvesting in long-term foundations. Building a sustainable manufacturing economy requires patience and strategic thinking that can be difficult to maintain amid enthusiasm. China's response to losing manufacturing market share reveals interesting strategic calculations. Rather than simply accepting the shift, Chinese policymakers are pursuing several adaptive strategies. First, moving up the value chain, focusing on more sophisticated products where their technological capabilities and infrastructure remain advantageous. Second, expanding influence in other developing regions, particularly Africa and Southeast Asia, to maintain export growth even as American and European markets become less accessible. Third, boosting domestic consumption to reduce dependence on exports entirely. Though this requires cultural and policy shifts that take decades to achieve, the psychological framing here is crucial. From China's perspective, this isn't defeat, but evolution. Chinese strategic culture emphasizes long-term thinking and adaptation to changing circumstances, drawing on historical experiences like the century of humiliation that taught the importance of resilience and self-reliance. This doesn't mean China will simply accept diminished influence, but rather that the response will be calculated and sustained rather than reactive and emotional. The broader geopolitical implications situate nearshoring within a possible transition from a unipolar globalized world to a multipolar, regionalized one. For 75 years following World War II, the global economy operated under American-led institutions like the World Bank, International Monetary Fund, and World Trade Organization, with relatively free flow of goods, capital, and, to a lesser extent, labor across borders. This system delivered unprecedented growth and poverty reduction, but also created vulnerabilities exposed by the trade war and pandemic. The emerging alternative isn't necessarily a return to autarky nations, trying to produce everything domestically, but rather a shift toward regional trading blocs. North America might integrate more tightly. Europe might strengthen its internal market while reducing Asian dependence. And Asia might develop its own networks less oriented toward Western markets. This regional model resembles patterns from earlier historical eras, particularly the imperial trading systems of the 19th century, though without the explicit colonialism. The philosophical implications of this shift touch on fundamental questions about human organization and values. Extreme globalization rested on certain assumptions that efficiency and economic growth should be paramount values, that political differences needn't impede commerce, that interdependence would foster peace by making conflict economically irrational. These assumptions drew on Enlightenment optimism about reason, progress, and universal human interests transcending tribal loyalties. The turn toward nearshoring and regionalization reflects, in part, a reassertion of particularistic values, national interest, cultural identity, and political sovereignty over universal economic logic. This isn't necessarily regression, but rather recognition that human beings aren't purely rational economic actors. We care about communities, we value control over our destinies, and we accept economic costs to preserve autonomy. The philosophical tension between cosmopolitan universalism and rooted particularism has existed throughout history. Nearshoring represents the latest iteration of this eternal debate. The psychological dimensions of decision-making under uncertainty thread through this entire narrative. Corporate executives deciding where to locate production, workers choosing whether to develop new skills, policymakers weighing infrastructure investments all face fundamental uncertainty about future conditions. Will Mexico's security situation improve or deteriorate? Will American politics remain supportive of nearshoring or swing toward isolationism? Will technological change, particularly automation and artificial intelligence, reduce the importance of labor costs and geographic proximity entirely? Faced with such uncertainty, humans deploy various cognitive strategies. Some rely on pattern recognition, assuming the recent past predicts the near-future strategy that works until discontinuous change occurs. Others embrace optionality, making flexible investments that preserve future choices rather than committing irreversibly to a single strategy. Still, others engage in scenario planning, imagining multiple possible futures and ensuring robustness across them. The most sophisticated actors blend these approaches, but even they cannot eliminate uncertainty's fundamental discomfort. The cultural dimensions of this transition deserve emphasis. Manufacturing isn't merely an economic activity, it shapes national identity and social structure. For the United States, the decline of manufacturing over recent decades contributed to political polarization, economic inequality, and regional disparities that have profound social consequences. The communities that lost manufacturing jobs experienced not just economic hardship, but loss of social cohesion, rising substance abuse, declining life expectancy, and political alienation. Nearshoring won't reverse these trends entirely, but it could stabilize them by preventing further erosion. For Mexico, expanding manufacturing creates opportunities for social mobility and modernization, but also risks environmental degradation, labor exploitation, and cultural disruption if not managed thoughtfully. The cultural psychology here involves questions of identity. What does it mean to be American when America doesn't make things? What does it mean to be Mexican when traditional ways of life give way to industrial modernization? These aren't merely abstract philosophical questions, they affect how people understand themselves and their place in the world. The environmental dimension adds another layer of complexity, often overlooked in purely economic analyses. Globalized production with components shipped around the world multiple times before final assembly creates enormous carbon emissions. Nearshoring reduces this transportation footprint significantly. A product manufactured in Mexico and shipped to California generates a fraction of the emissions of the same product made in China. However, this benefit depends on how cleanly Mexican factories operate. If nearshoring simply relocates dirty manufacturing from China to Mexico without improving environmental standards, the net effect could be negligible or even negative if Mexican environmental enforcement is weaker. This highlights how nearshoring's impact depends on implementation details, not just the geographic shift itself. The psychological tendency towards simplistic thinking, nearshoring good, offshoring bad obscures these nuances. Reality is messy, requiring sustained attention to multiple variables rather than reduction to simple narratives. The timeline of this transition matters for understanding what comes next. We're currently in what might be called the early adoption phase. Leading companies have committed to nearshoring strategies, but the majority of global manufacturing remains where it was. The infrastructure Mexico needs to truly compete with China is still under development. The workforce expansion and skill development required will take years. Supply chain reorganization happens gradually because coordination across thousands of companies requires time and trust building. Based on historical parallels, complete transitions in global manufacturing patterns typically occur over decades, not years. The offshoring wave to China began in earnest in the 1980s, but didn't peak until the 2000s, a 20-year process. Nearshoring to Mexico likely follows a similar trajectory. We're perhaps 5 years into what could be a 20 or 30-year shift. This temporal perspective helps calibrate expectations. The transformation is real and significant, but it's also gradual and incomplete. Looking forward, several scenarios seem plausible. In an optimistic scenario, nearshoring succeeds brilliantly. Mexico develops world-class manufacturing capabilities, creates millions of well-paying jobs, and integrates deeply with American and Canadian economies in a mutually beneficial partnership. Supply chain resilience improves, reducing vulnerability to future shocks. Environmental standards rise as proximity enables better oversight. This scenario isn't guaranteed, but neither is it fantastical. It represents the successful realization of nearshoring's potential. A pessimistic scenario sees infrastructure constraints, political instability, or security concerns limiting Mexico's manufacturing growth. Companies that nearshore discover they've simply traded Chinese risks for Mexican ones without gaining the anticipated benefits. The result is disillusionment and possibly another shift, perhaps toward automation, that eliminates the labor cost question entirely or toward yet other countries in a perpetual search for optimal production locations. This scenario reflects how uncertainty can frustrate even well-reasoned strategies. A middle scenario, perhaps most likely, sees partial success. Nearshoring establishes Mexico as a significant manufacturing center for certain industries, particularly those where proximity matters most, like automotive, electronics, and medical devices, while other industries remain in China or disperse to various Asian countries. The global manufacturing landscape becomes genuinely multipolar, with no single dominant producer. This scenario captures how complex systems rarely move cleanly from one equilibrium to another, but instead fragment into messy, mixed patterns. Human decision-making under uncertainty tends to produce such outcomes because different actors with different risk tolerances and incentive structures make different choices, creating diversity rather than uniformity. The role of technological change introduces additional uncertainty. Automation and artificial intelligence are advancing rapidly, potentially transforming manufacturing in ways that reduce labor's importance. If robots do most factory work, the advantage of low-wage countries diminishes. Manufacturing might even return to developed countries where it can be co-located with design and engineering teams without the labor cost penalty. This could make nearshoring a transitional phenomenon, significant for a few decades before technological change renders geographic labor arbitrage obsolete. Alternatively, automation might proceed more slowly than optimists predict, restrained by technical challenges, capital costs, and social resistance to job displacement. Forecasting technological trajectories is notoriously difficult. Expert predictions consistently overestimate short-term change while underestimating long-term transformation. The safest assumption is that technology will matter enormously, but in ways we can't precisely anticipate. The comparison to other historical transitions in manufacturing geography illuminates recurring patterns. Britain's dominance in the 19th century gave way to American and German industrialization. American manufacturing supremacy in the mid-20th century yielded to Japanese competition. Japan's challenge was superseded by China's rise. Each transition involved technological change, shifts in comparative advantage, and geopolitical realignments. Each was predicted by some observers and surprised others. Each created winners and losers, required painful adjustments, and ultimately reshaped global economic and political power. The current shift from China to Mexico fits this historical pattern. It's neither unprecedented nor fully predictable in its consequences. History suggests that manufacturing power correlates with, but doesn't determine overall geopolitical influence. Britain remained politically powerful long after losing manufacturing dominance. The United States maintained global leadership despite manufacturing decline. Whether China follows this pattern, or whether manufacturing capability remains more crucial in the 21st century, remains to be seen. The psychological literature on collective decision-making helps explain how nations navigate such transitions. Countries aren't unitary actors with single minds, despite how we speak about them. They're collections of competing interests, labor, and capital. Export industries and domestic-focused businesses, political factions with different ideologies, engaged in ongoing negotiation and conflict over policy. The decisions that emerge reflect not optimal strategies, but political equilibria, where various forces temporarily balance. Understanding nearshoring, therefore, requires examining not just economic logic, but political economy. Which groups have power? What coalitions form? How institutional structures channel interests into policy? In the United States, the nearshoring trend reflects an unusual alignment of labor unions wanting jobs back, corporations wanting supply chain security, and politicians wanting to demonstrate action on China. This coalition is fragile and could fracture if circumstances change. In Mexico, the coalition favoring nearshoring includes business elites, export industries, and politicians claiming credit for growth, while opposition includes those worried about environmental damage, labor exploitation, or excessive American influence. These political dynamics shape how nearshoring unfolds. The cultural comparison between Chinese manufacturing psychology and emerging Mexican manufacturing culture reveals interesting contrasts. Chinese manufacturing success rested partly on what some scholars call Confucian capitalism: emphasis on education, family sacrifice for future generations, respect for hierarchy, and long-term orientation. These cultural traits complemented manufacturing's demands for discipline, skill development, and delayed gratification. Mexican culture, while difficult to generalize, traditionally emphasizes different values: family closeness, work-life balance, personal relationships over formal rules. Whether these cultural differences affect manufacturing competitiveness is debatable and potentially stereotypical, but culture clearly influences economic behavior in subtle ways. The question is whether Mexican manufacturing develops its own distinctive approach that succeeds on different terms rather than simply mimicking Chinese or American models. The role of trust in supply chain relationships deserves attention. Manufacturing networks require extensive coordination and information sharing among companies that are simultaneously partners and potential competitors. Trust reduces transaction costs and enables flexibility that formal contracts cannot fully specify. Building trust takes time and repeated positive interactions. One advantage China developed was precisely this: trust network companies knew which suppliers delivered quality, which met deadlines, which could handle rush orders. Mexico is still building these trust networks. Early successful projects create positive track records that facilitate future cooperation, but setbacks damage fragile reputations. The psychology of trust formation shows that people extrapolate from small samples, especially negative experiences. A single quality failure or delivery delay can taint perceptions disproportionately. While positive performance takes repeated confirmation to establish confidence, This asymmetry means Mexican manufacturing must not merely match Chinese quality, but exceed it initially to overcome skepticism and build reputation. The educational dimension matters crucially for long-term success. Manufacturing increasingly requires not just manual dexterity, but technical knowledge understanding, computer-controlled machinery, interpreting quality data, implementing process improvements. Mexico's educational system faces challenges in delivering these skills at scale. Universities produce engineering graduates comparable to those anywhere, but technical vocational training that builds workforce depth remains inconsistent. Addressing this requires sustained investment in education that competes with many other pressing needs for limited government resources. The psychological challenge is maintaining focus on long-term human capital development. When short-term infrastructure or security needs seem more urgent, behavioral economics teaches that present bias overvaluing immediate concerns relative to future ones affects governments as much as individuals, potentially underinvesting in education, whose benefits emerge over decades. The financial dimension of nearshoring involves enormous capital requirements. Building factories, purchasing equipment, training workers, and establishing logistics networks costs billions of dollars. Companies must decide whether to invest their own capital or seek external financing. Investors evaluating these opportunities weigh potential returns against risks in a context of uncertainty. The psychological biases affecting investment decisions over confidence in positive scenarios, anchoring on recent trends, herd behavioral influence capital flows toward or away from nearshoring. Financial markets can amplify transitions as success attracts investment that enables more success, creating momentum. Alternatively, early setbacks can trigger capital flight that becomes self-fulfilling prophecy. Understanding nearshoring, therefore, requires attention to financial psychology and market dynamics alongside industrial economics. The story of nearshoring ultimately reflects how humans respond to changing circumstances, adapting strategies, updating beliefs, and reorganizing relationships in light of new information and shifting constraints. The move from China to Mexico isn't predetermined or inevitable. It results from countless individual and collective decisions by people facing uncertainty and pursuing their interests as they understand them. Some of these decisions will prove wise, others mistaken. Some actors will benefit, others lose. The aggregate outcome emerges from this distributed decision-making process in ways no single actor fully controls or anticipates. This is both the strength and the frustration of market economies. They adapt organically to changing conditions. But without central direction, they also produce inefficiencies, injustices, and unexpected consequences that require ongoing correction. As shipping containers that once flowed primarily across the Pacific increasingly move across the Rio Grande, we're witnessing not merely a shift in logistics, but a fundamental reorganization of global economic geography. The labels on our products tell a story about manufacturing economics, geopolitical tensions, supply chain vulnerabilities, and the eternal human search for advantage in a competitive world. Made in Mexico represents not a final destination, but another waypoint in the endless evolution of how humanity organizes production. The factories rising in Monterrey and Tijuana stand on foundations of economic logic, geopolitical strategy, and human adaptation. Whether they succeed in becoming the new centers of global manufacturing depends on infrastructure development, political stability, workforce training, technological change, and countless decisions yet to be made. History suggests that no configuration of global manufacturing is permanent. Comparative advantage shifts, technologies evolve, political priorities change, and what seems inevitable today becomes obsolete tomorrow. The movement from China to Mexico makes sense given current conditions, but those conditions will themselves transform in ways we cannot fully foresee. What remains constant is that wherever things are made, they reflect human needs, human ingenuity, and human limitations, our need for goods, our cleverness in producing them efficiently, and our inability to predict or control the complex systems we create. The next chapter in manufacturing's global story is being written now in factory floors and boardrooms in government offices and investment firms, by people making consequential decisions under uncertainty, each playing their part in a transformation whose full significance will only become clear in retrospect.